Hi, everybody. My name is Patricia. I'm with eXp Realty, and this is my colleague, Gustavo Segura. How are you doing today, Gustavo?
Hi, I'm doing good. Thank you for having me.
Great. So we host this workshop every Wednesday at 5 p.m. We stream it live on YouTube and Facebook. And this workshop is basically just educational information on all the steps involved on buying a home. So if you have any questions throughout the process or want to get started, please feel free to reach out to us and we will definitely give you a roadmap on what the steps are to get started in the home process. So I wanted to start off today with just talking about the interest rates because I know there's been some fluctuation there. And I'm going to share my screen right now so that we can see where the rates are at and what the activity is like. So today we are at 7.22% for a 30-year fixed. And as you can see here, today is November 9th. We're at 7.22. This blue line here shows the fluctuation in the interest rates. So on October 24th, we were at 7.29. So we've been definitely hovering over the 7% range since it looks like the beginning of October, we were under 7%. As of October 12th, we were at 6.81. So as you can see here, we are fluctuating over 7%. And today's topic, we're talking about the interest rates and also how you can structure your financing in order to leverage this market and what opportunities are available for you right now as a home buyer. Even if you're looking to sell your property because maybe you might be thinking of downsizing or upgrading, and so that would make you a home buyer as well. So we're going to talk a little bit today about some of the key words that you will find lenders that are pitching in today's market that'll say, discount points or a premium. And if you hear those words, sometimes it may sound like you're saving, like it's something that is causing you to save money, when in actuality, it's a fee that you're going to pay. And so we're going to go a little bit more into detail about that and what that looks like. So for example, if we're talking about getting a loan, let's say a $600,000 loan, and maybe you're getting an FHA loan, which is a government-backed loan, and there's a discount point involved. What does that look like, Gustavo, if let's say somebody is coming to you saying, I have an estimated quote from another lender, and they're stating that I qualify for a $600,000 purchase, but I have to pay a discount point or points. What does that actually mean in the terminology for us home buyers that are looking to buy a home?
Yeah, definitely. So whenever I see competitive quotes is because, they come to me, like you said, and they're saying, I'm getting a 6% rate or 6.5%. And that's great, but we need to see the other side of it, which is the cost. They may be overpaying for that percent, so when we talk about the points, the discount points, that is a buyer paying 1% of the loan amount in order to bring down that rate. So 1 point is usually 1% of the loan amount. So like you said, $600,000 loan, that means at 1 point, you are paying $6,000 to bring down that rate. And typically, depending on the situation, you're going to be about a quarter of a percent to 3/8. So if you had a 7% and you're paying 1 point, then you could be coming down to a 6.75 to 6.625, somewhere around there. And that could be a savings of $105, $110. It all depends, somewhere around there. So that's where I want to take a look at a quote and see not just the rate, but also how much they're getting charged for that rate. Then I can say whether it's a good deal for them or not, or if I have something better for them, here's the reason why, right? You're paying less, you're getting the same rate. Every lender will have different rates and they have different margins. So it's very important to shop around and to be able to understand why you're getting that rate and then also what's in your cost.
Right. And so that's a really good point because I think some of the vocabulary and terminology that's used is not really fully understood across the board. So
Yeah.
if you're looking at paying discount points, it's not something that you're initially saving. It is going to essentially save you money, but it's actually a fee that you're paying up front in order to buy down that rate, which in turn will end up lowering your mortgage payment by maybe
Right.
a few $100, depending on if you buy down 1 point or 2 points.
Correct. And right now in this market, because of the high rate, I'm seeing a lot of retail lenders that are putting 1 to 2 points on each loan. So you call them, they give you a quote, they say, yeah, we got a 6%, 6.5%, and you're like, great, you know, like I'd like to take a look at that. They run your credit, they go through that, they deliver the loan estimate to you, and it has on there, you know, 1.5 points or 2 points on there. You know, like you said, 600,000, 2 points, that's $12,000 just to buy down that rate. Now you tackle that onto your traditional closing costs, which could be another 2 to 3% or 4%. So you're going to be, you know, closing on that for about $40,000 or so. So it could be a big closing cost expense for you. So definitely take a look at those numbers. And like I said, I like to walk through them and I show them exactly what they're paying for so they understand.
Okay, great. Now let's talk about FHA loans. So for FHA loans, usually the down payment is 3.5% for a 30-year fixed.
Yeah.
And FHA loans traditionally will already have a lower percentage than whatever the rates are. Like for example, the rates today are 7.22. So what would a rate be for, let's say, FHA? It's usually about a percentage lower, right?
Yeah, exactly. Usually around 1% difference. So that could be a really great program for someone that needs the flexibility of the credit, you know, credit score, right? So they got someone that's a 620 or 580 credit score. Being able to at least be able to get that loan and get that home is going to be a big key factor. And FHA loans will allow that buyer to get that home ownership. So a little bit lower rate. Yes, they have additional fee, which is you're paying for it's an upfront mortgage insurance cost, but you're able to save on the rate and being able to get that flexibility to get the home that eventually could pay off by gaining equity and home ownership.
Right. And with FHA, since you're already getting that lower interest rate, can you still buy down the interest rate further by paying the additional discount point?
Yeah, definitely can. And you know, in this market too, we're seeing seller concessions, right? So we can take a seller concession and help buy down that rate, and or be able to take the closing costs down as well. So you can take a seller concession, pay for the closing costs, help out with that upfront mortgage insurance cost as well. So it could still be a very good situation.
Okay, fantastic. I think in today's market, FHA is a really good way to go to get into a home that you're looking to purchase, just because even if you had more of a down payment right now, but you can save some of that money in your reserves in case you have some kind of emergency in your home. Maybe there's a plumbing issue or an electrical issue. There's usually some type of expense that you incur when you're purchasing a home, and once you get moved in and you have your utilities on, there's, usually some kind of expense that you're going to incur once you start actually moving in and getting settled in.
Yeah, no, definitely. And that's one of the scenarios that I go through with buyers. When they tell me they have maybe 60 or $100,000 down payment and that's in their bank, we may be able to put everything to work on there, but sometimes it's better to maybe put half of that, and I show them the difference in payment. Look, you can put an extra $40,000 down on it. Your payment may be $300 less, but don't you feel better buying the house, having $40,000 or $30,000 in the bank and saying, okay, I'll pay an extra $300 a month right now, but I still have my savings. I still have that cushion. As something happens, I can dip into. So it's a good scenario to also think about.
Yeah, because you might have a car payment that you're, a car balance on your loan for your car that you may be wanting to pay off. So having that reserves would be helpful in case you wanted to maybe just pay off a credit card or a remaining car balance, for your loan. You could pay that off as well.
Yep, yep. And for families, I mean, having kids, there's always an emergency. Something always happens. And, you take the
Isn't that
kids
the
to the
truth?
emergency room. Yeah, I took my son recently to the emergency room because he broke a finger. And yes, you have insurance and all this, but you still got to end up paying $1,000 here, $1,500, and you're like, all right, well, unexpected costs. So I think because of that, I take a look and I give them additional feedback on that and I say, look, I don't want to use up all the money. What about if you do this? Here's this scenario. How do you feel about it? And then that way they can make a more informed decision.
Yeah, I really like that approach because it provides that full overview of how they can best use their cash and where they should really, invest that money. Is it the 3.5% down? Is it maybe putting down a little bit more to lower that payment for you to make it more comfortable? Or is it keeping that cash on hand just so you can have that, security in case there is an emergency that comes up, like you mentioned with your son, breaking his finger.
Yeah. Yeah.
Next time, just snap it back into place.
That's what I told them, especially after I got the bill.
Yes.
So,
You're the loan officer and the home remedy doctor.
yes, exactly.
So, as far as I know, I've been asked this question recently with conventional financing. So we just went over FHA financing and what the required down payment is for that. And for conventional, I know that some of the questions I've had recently are, do I have to put down 20% for a conventional loan? And what happens if I put down 10%? Can I even put down lower than 20%? So what are the requirements, let's say for FICO, to get a conventional loan and putting down, 20% versus 10 or even 3%? We can also do 3% on a conventional loan, right?
Yeah, exactly. So that's the big thing that a lot of people think it's 20%. They think conventional 20%. If you're a first-time home buyer, you got to go FHA, and that's not the reality. Before you weren't able to do cash outs with FHA, now you can. So the lending world has continued to change, and with conventional, you can put down as little as 3%. Yeah.
Did you just say cash out on a FHA?
Yes, you can do cash out on FHA.
Okay. Can you elaborate a little bit on that?
Yeah, so they take a look at everything, loan to value. They take a look at your debt to income ratio. We're basically taking a look at your loan again, and we talked about that mortgage insurance, right? So that mortgage insurance that you're paying, and you paid up front, if you refinance within a 3-year period, you were able to get a credit for some of that. So whenever we're doing a refinance, we take a look at when you got that loan. If it was a year and a half ago, there's a calculation that we use in order to be able to still use some of that and get the credit so that you don't have to pay again for the mortgage insurance up front. So the government does a good job there and gives you credit and says, well, you just paid this fee of 1.75, you just paid it a year and a half ago. Let's prorate it for you, So you just kind of go through that process again and again. It's a great product because you can get money out and you still keep a low rate.
Okay, fantastic.
Yeah.
And you can also apply for another FHA loan as long as you don't have one already on the books, right?
Right.
So you have one FHA loan at a time.
Yeah, right. So you don't have another property or anything like that. It's got to be your primary. And on the conventional, you can go down to 3%, so even lower than the FHA, right? So why is that? And that is because you just need to have a little bit better credit score. So typically if you have a 740 plus or even 700, you're going to want to go conventional. It's less cost. You don't have that upfront insurance cost, the mortgage insurance cost. You don't have that. You still have mortgage insurance, your monthly, because you put down less than 20%. But it's overall it's less cost when you're doing a conventional loan. And the reward for having a better credit score, lower debt to income ratios, is being able to get a loan that costs less, and it's also going to have a good rate.
Okay, and is there any kind of reserve requirement? Like, do you have to have a certain amount of cash, available in your bank, in your savings or checking account, or even 401k in order to do a conventional with a 3% down?
No, it all depends on the situation. So the credit profile. So if we have somebody that is a strong borrower with a low debt to income ratio, there may not be any need for any kind of reserves. Sometimes they may want 2 or 3 months, but it all depends on the situation. So, mhm.
Okay.
And
That's really good.
because you've got, say you're paying 3%, you put down 3% or 10% down, you didn't do that 20%, you're still gonna have that monthly mortgage insurance. But once you get to that 20% mark, you're gonna be able, where you have 20% equity on the house, you pay down the loan and you're at 20% equity, you're gonna be able to get that removed, as opposed to the FHA loan. The FHA loan, once you get to 80%, it will still keep going. So it's different on the conventional. Once you get to that 80% and below, that will come off. So that will save you some money. On an FHA loan, you have to refinance out of that FHA loan into a conventional in order to get rid of it.
Right. Yeah,
Yeah.
that's exactly what I did. I bought my
Yeah.
home with an FHA loan. I put 3.5% down. And
Mhm.
then after, I think it was about a year and a half, maybe
Yep.
on 2 years, I refinanced into a conventional loan and got rid of the PMI. And I think it
Yep.
was about $250 I was paying a month.
Yeah. Yeah. So you're able to do that. And, maybe the rate was a little bit higher, or maybe it stayed around the same, but being able to get that $250 off of the monthly, it's a great benefit.
Yeah,
Mhm.
absolutely. I think I was paying 4% at that time.
Okay.
Yeah. Of course, that was, before.
The good old times. Yeah.
Yeah, we all got spoiled by the last 2 years where we were
Yeah.
seeing 2.5%, 3%.
Yeah.
So I know another loan product that is really getting to be more popular right now is the adjustable rate mortgage. And that's really helping buyers get into a home because can you combine the adjustable rate mortgage with what we were just talking about, the 3% conventional or the 3.5% FHA?
Yeah, so you can get that ARM, right? It's a 5-year fixed period, or 7 years or 10 years. So these are the lenders coming with different options where your rate will be fixed. After that period, it's going to adjust based on a market index. Now, yes, you can still use seller concessions. You can still go through that, buy down. It's going to be something that it's very useful right now in this kind of market where the rates are high. It's something that can allow someone to get into the house and then be able to refinance within that 5-year period, for example. The market is going to change probably a couple times during the next 5 or 7 years. So it gives someone that flexibility. Now, we qualify someone at the fully amortized rate. So we don't take the lower rate and then we approve them for them, because then when the rate adjusts, they will have a payment shock that they may not be able to pay for, right? They may not be able to afford. So now we're using the fully amortized rate so that we can make sure that if they let this loan go all the way through the adjustment period, they will go ahead and be able to still pay for that home. They'll be able to qualify.
Right. Yeah, I think I've seen more adjustable rate mortgages, in the last couple of months, just the interest rates going up. I've also seen more FHA loans coming online. And the good thing about that is that sellers are looking at all types of loans right now, not just the sexy conventional loans, but they're also looking at VA and FHA loans.
Yeah, VA loan for a long time, very typical to FHA. Any kind of government loan was getting frowned upon, through the last couple of years. They wanted cash, they wanted conventional, they wanted, 15-day closing, all those kinds of things, right? And government loans typically will follow guidelines. So they want to make sure that the borrower, the house, the property, everything is going to be safe and it's going to be good, right? So there's extra checkpoints. And a lot of times the sellers don't want to deal with that, unfortunately. So, now, like you said, they're open up to accepting these kinds of loan products, when in reality they were always good. It was just, everybody was impatient and they wanted the cash offer and they wanted the quick closing.
Right.
But VA loans are another great program, 0% down. So anybody that's been in the military or currently is, 0% down payment on that, and there's no mortgage insurance on that either. So it gives them great flexibility to buy that home and then be able to start home ownership.
Right. Yeah, the VA loans are really a great tool to get into a home right now, because as you said, there's no money down. And is there any requirement for a FICO minimum?
No, yeah, that's another thing too. There's no FICO requirement there. There's no debt to income ratio requirement. They use a different calculation, which is for residual income. So after everything gets paid, there's a calculation for how much they should have left over, depending on the number of members in the family and the household. So as long as they meet that requirement, that threshold, their debt to income could be 60, 70%, and they will get approved. So
Okay, great.
yeah.
That's so helpful just to have a, conversation about all the different opportunities there are right now for different types of financing that buyers can get right now. So this is really a market where there are negotiations that are happening. There's closings happening every day. And, we're here to answer any questions that you guys may have and just help you get started. And if it's not a good time for you to buy right now, then we'll look at all of your information and help guide you to that decision. If it is something that maybe it's worth waiting a few more months, maybe you do need to save up a little bit more money for a down payment or for closing costs. But that's why it's important to reach out to us so that we can really sit down with you and just guide you through that process and give you a complete overview of what it is that you're looking at as far as closing costs, and even what your rate would be and what your monthly payment would be. So we'll fully break that down for you and give you a clear, transparent picture of that.
Exactly. Yep. Well said.
Gustavo, thank you so much for your time today. And if somebody wanted to get a hold of you, what's the best way to reach you?
Yeah, thank you. And it's directly on my cell phone, 714-334-4563. Call or text. I'm always by it.
That's true. You always answer me right away. So I love that.
Yeah. Thank you.
All right. And if anybody wanted to get a hold of me, you can reach me on my cell phone as well. And that's 323-365-9909. Thank you so much for joining today. And I will see you on the next one.
Thank you. Thank you, guys. Bye-bye. Bye.